All right, let's dive into a world that might seem a little dry at first glance, but it impacts all of us. We're talking cost of capital.
Oh, yeah.
Specifically, 10 hot topics
Yeah, hot topics.
that are really shaking up the energy and utilities sector.
Yeah,
And,
big time.
you wouldn't think that something like
Yeah.
cost of capital calculation
You really wouldn't.
could be so dramatic,
Well,
but
I-
we're talking billions of dollars
It is dramatic.
riding on tiny changes
Yeah.
in these numbers.
And tiny changes.
So you've handed us this report.
We got.
Cost of Capital 10 Hot Topics, published just a couple months ago.
Yeah. Cost of Capital and Hot Topics just came out.
Authored by PJ and Warwick Anderson from MCC Economics.
Published in July.
So we know it's coming from some serious experts.
July 2024.
And they've analyzed decisions from regulators in Australia, New Zealand, and the UK.
Yeah, so PJ McCloskey and Warwick Anderson are from MCC Economics.
Yeah.
And, they're experts in this area.
It's like a global battleground of cost of capital.
Yeah, and they've analyzed decisions from regulators in Australia, New Zealand, and the UK. So it's kind of like a global perspective.
Okay, so let's unpack the first hot topic here. Climate change objectives.
Okay.
I mean, it's on everyone's mind these days.
Sure.
But how are regulators actually factoring this into these cost of capital calculations?
Yeah, so the New Zealand Commerce Commission, they call it the NZCC.
Okay.
They looked at two key angles here.
Right.
First, how this whole shift towards renewable energy is impacting demand for traditional fossil fuels.
Yeah.
And then second, how climate change itself is increasing the need for more resilient infrastructure.
Right.
Think like stronger power lines that can withstand extreme weather events.
So are they saying climate change is making everything more expensive?
Right.
Is that why my energy bill keeps going up?
It's not a direct link like that,
Okay.
but it is definitely a factor. So the NZCC, they ultimately decided that specific adjustments to the cost of capital weren't needed right now.
Okay.
They're emphasizing flexibility in their regulatory decisions, like adjusting prices if necessary.
Uh-huh.
So it's kind of a wait-and-see approach, but with a recognition that things could change really quickly.
Interesting.
Yeah.
So what about Australia? They've got some ambitious climate targets too, right?
They do. They actually have incorporated a new energy emissions objective right into their national laws.
Wow.
So that means that regulators now have to actually consider emission reduction targets when making decisions about, how much revenue energy companies can earn.
Wow. So they're not messing around.
Yeah, they're serious about it.
Does that mean they're automatically penalizing companies that aren't hitting those targets?
No, not penalized. It's not like a direct punishment,
Okay.
but it is
Yeah.
definitely factored in. So, for example, if a company needs to upgrade its infrastructure to be more climate resilient, those costs can now be included
Right.
when determining, what's a fair rate of return.
So in a way, it's making those investments more attractive.
Exactly.
To companies.
Aligning the financial incentives
Right.
with the climate goals.
Makes sense.
Yeah.
Okay, let's move on to hot topic number 2, stability and predictability.
Okay.
Sounds a little boring, but I have a feeling
Yeah.
it's a lot more important.
Maybe not the most exciting topic,
Yeah,
but it's definitely a crucial one.
than it sounds.
Remember utility companies.
Right.
They're all about long-term investments.
They're playing the long game.
And steady returns. They're not looking for quick profits. They're playing the long game.
Right. Like those giant wind turbines.
Exactly.
Those things are there to stay.
For a while.
And that's why stability in the regulatory environment is absolutely crucial.
Right.
If utilities and investors are constantly worried about sudden changes in the rules,
Yeah.
it can really discourage investment and innovation.
Right. It's like laying a solid foundation.
You need that stability before you can build anything worthwhile.
That's a perfect analogy.
Okay.
You need that solid ground before you can build anything meaningful on top of it.
So in this case, the Australian energy regulator, the AER,
Is the AER.
decided that sticking with their existing approach to cost of capital calculations was actually the best way to ensure that stability.
Yeah. So they recognized that there were arguments for, maybe tweaking things a little bit. But ultimately, minimizing disruption was seen as the most beneficial course of action.
So a bit of a if it ain't broke, don't fix it mentality.
You could say that,
Okay.
but it's not about being complacent. It's about recognizing that sometimes consistency is more valuable than trying to chase every new trend or idea.
Okay, I can see the logic there.
Yeah.
But how do they ensure that those calculations are still relevant in a rapidly changing world?
That's a great question, and it leads us perfectly into our next hot topic.
Right.
reasonableness checks.
Okay.
So these are basically the safeguards that make sure the numbers.
So it's like a reality check
Exactly.
for cost of capital.
A reality check for cost of capital are reflecting reality
Yeah.
and not leading to absurd outcomes.
How does that actually work? Do
Yeah.
they bring in a panel of everyday people to see if the numbers make sense?
I wish it were that simple.
Yeah.
But it's a little bit more technical than that.
Okay.
So regulators, they use various models and data to come up with their cost of capital estimates.
Uh-huh.
But then they apply several checks to see if those numbers actually hold up in the real world.
Okay, give us an example.
Yeah, so one common approach is to compare the calculated cost of capital to the actual returns being earned by similar companies.
Okay.
They also look at, historical profitability and investment trends.
Okay.
It's about making sure the numbers aren't completely out of whack with what's happening in the market.
So if a company is suddenly demanding a much higher return on investment than its peers, that might raise a red flag.
Exactly.
Okay.
It could signal that they're trying to game the system or that their assumptions are unrealistic.
I'm starting to see how this gets complicated. There's a lot of judgment involved, right?
It is.
It's not just plugging numbers into a formula.
It's more like detective work than, just plugging numbers into a formula.
Okay.
Regulators have to sift through the data, weigh different factors, and ultimately decide if the cost of capital calculations pass the sniff test.
And this whole process
Yeah.
can get pretty controversial, right?
It can get pretty heated.
Yeah.
There are always going to be disagreements about what's reasonable.
Yeah.
Companies want to maximize their profits.
Sure.
Investors want the highest returns, and consumers want affordable energy. So it's a constant balancing act.
So who usually wins these arguments?
Well, it's not really about winning or losing.
Okay.
It's about finding a solution that balances the interests of all stakeholders. And that's where things can get really tricky.
Okay, so tell us about one of these tricky situations.
Yeah. So one particularly heated debate revolves around the use of something called RAB multiples.
RAB multiple.
Yeah, RAB multiples. It sounds very technical.
Technical.
It is a bit technical,
Okay.
but it's important. So RI stands for regulatory asset base,
Okay.
which is basically the value of a company's assets that are used to provide regulated services like those power lines we were talking about before.
Okay.
So a RAB multiple is just the ratio of a company's market value to its RI.
Okay, so it's comparing the company's stock market value
Right.
to the actual value of their physical stuff.
Exactly.
Okay.
And some argue that a high RB multiple could mean that a company is earning excessive profits. So if the market is valuing a company way higher than the worth of its assets,
Yeah.
it could be a sign that they're making more money than they should be.
But others would say that that's just the free market at work. A
Exactly.
successful company
Right.
is worth more than the sum of its parts.
A successful company is worth more than the sum of its parts, and that's where the debate gets really interesting.
So where do regulators stand on this?
Well, both the NCCC and the AER, they've been wrestling with this. The AER ultimately concluded that RB multiples can be a useful sense check,
Okay.
but shouldn't be the only factor in their decisions.
So a cautious approach.
Yeah,
It
a
is.
cautious approach.
Makes sense given the controversy.
Yeah, it does, and it highlights the challenges regulators face in trying to balance these competing interests and ensure a fair outcome for everyone.
All right, on to hot topic number 4. What's next on our cost of capital adventure?
All right, this one's a bit of a head-scratcher.
Okay.
The diminishing set of publicly listed comparator firms.
Okay. I'm intrigued.
Yeah.
What is that all about?
So to figure out the cost of capital, regulators often look at comparable companies that are publicly traded.
Okay.
They analyze things like their stock prices and debt levels to get a sense of what investors are expecting.
So it's like checking Zillow
Yeah,
to see what similar houses in your neighborhood are selling for.
exactly. A good benchmark.
Gives you a benchmark.
But here's the problem. More and more utility companies are being acquired by private equity firms and taken off the stock market.
So they're going off the grid.
Yeah, they're going private.
In terms of publicly available data,
Right.
that makes it hard to do these comparisons.
Exactly. It's like trying to figure out housing prices when all the sales in your neighborhood are suddenly happening behind closed doors.
Yeah, that's a good analogy.
Yeah.
So what are regulators doing about this shrinking pool of data?
Right.
Are they just throwing darts at a board?
Not quite throwing darts,
Okay.
but they are getting creative. So the NCCC, for example, has actually started to include international companies in its analysis.
Okay.
But even that has limitations because, companies operating in different countries
Sure.
face different risks and regulations. So it's not always a perfect comparison.
So they're having to cast a wider net, but the data might not be as reliable.
Exactly.
What about Australia? Are they facing the same data drought?
Even worse, actually.
Really?
They've lost two of their best comparator firms, Spark Infrastructure and AusNet, to private equity buyouts.
Ouch.
I mean,
So,
talk about a data blow. It's a real challenge. And the AER is planning to do more research on this to, figure out how to deal with it.
okay.
But for now, they're stuck using older data or less comparable companies.
So the data squeeze is on.
Yeah,
Doesn't sound like there's an easy solution.
no easy solution.
Definitely something to keep an eye on.
Definitely something to keep an eye on.
Okay, on to hot topic number 5. The term for estimating the cost of equity.
All right.
Now, I know equity is a finance term, but I need a little more context here.
Sure.
What are we talking about?
This boils down to a debate about how far into the future regulators should look when calculating the cost of equity.
Okay.
Should they focus on the short term, maybe the length of the current regulatory period, or should they take a longer view, perhaps the entire lifespan of the assets?
Okay, I'm starting to get it.
Yeah.
It's like deciding whether to invest in a trendy new stock
Yeah.
that might explode in value next year or a solid old school company that will steadily grow over decades.
You got it. And just like in investing, there are pros and cons to both approaches, right?
Okay.
Focusing on the short term might be more responsive to current market conditions, but it could also be more volatile and unpredictable.
Mm-hmm.
Taking a longer view might be more stable, but it could miss out on important near-term trends.
So who's winning this debate, short term or long haul?
It depends who you ask.
Okay.
The AER decided to stick with their current approach,
Okay.
which uses a 10-year term,
Okay.
despite some calls for maybe using a shorter time frame.
Okay.
They felt that consistency and predictability were paramount, especially with all the uncertainty in the energy sector right now.
So sticking with the slow and steady wins the race philosophy.
Pretty much.
What about New Zealand?
They went a different route.
Okay.
They're sticking with their existing approach, which matches the term to the length of the regulatory period.
Okay.
They argue this ensures consistency between how they estimate the cost of debt and equity.
So different approaches, both with their own logic. Seems like there's no one-size-fits-all answer here.
No one-size-fits-all answer.
Yeah.
Each regulator has to weigh the various factors and make the decision that they think is best for their specific circumstances.
All right. On to hot topic number 6, accommodating large new investments. I
Okay.
imagine this is especially relevant now with the huge push
Yeah,
for
absolutely.
renewable energy infrastructure.
You're right. As we transition to a cleaner energy future, we need massive investments
Yeah.
in things like wind farms, solar panels, and upgraded transmission lines.
Yeah.
But these traditional cost of capital calculations, which often rely on long-term averages,
Right.
might not be well suited to this new era of rapid change.
Yeah, I can see how that would be a problem.
Yeah,
It's like trying to navigate a speedboat through a harbor
I love it.
using a map designed for giant cargo ships.
The perfect analogy.
Okay.
These huge new investments can really skew those long-term averages.
So how are they dealing with this? Are they just throwing out the old rule book?
Not entirely. But they're experimenting. So the AER, for example.
Okay.
They're trying to figure out how to fairly compensate companies for these large upfront investments in renewable energy while still protecting consumers
Right.
from unreasonable price hikes.
It's a delicate balancing act.
It is a delicate balancing
Right, I
act.
say the least.
Absolutely. And they actually considered a weighted trailing average
Yeah.
approach,
What?
giving more weight to recent costs of debt,
Okay.
which are generally higher now as companies borrow money
Right.
for these new projects.
So acknowledging that we're in a different financial environment than we were a few years ago.
We're in a different financial environment, and that, those long-term averages might not be telling the whole story.
But even though this weighted average approach seemed pretty logical,
Yeah.
it wasn't implemented.
There wasn't a whole lot of support for it
Okay.
from stakeholders.
Yeah.
Even the companies that would have benefited from it.
Yeah.
So the AER ultimately decided that their existing trailing average approach was sufficient for now,
Okay.
as the impact of these new investments on the cost of capital is expected to be fairly gradual.
So a bit of a wait and see approach for now.
For now, yeah.
What about New Zealand? Are they doing anything differently?
Yeah, they're using a prevailing cost of debt approach,
Okay.
which means they look at current market interest rates when calculating the cost of capital.
Okay.
And this is obviously, more responsive to sudden changes in borrowing costs, which we're seeing right now.
So they're being a bit more proactive.
Yeah, I guess you could say
We're
that.
trying to stay ahead of the curve.
A bit more proactive, maybe.
Okay.
And it reflects the fact that New Zealand's energy sector is undergoing, a major transformation with all these investments in renewables.
Right.
They need a system that can adapt quickly.
It's fascinating to see how these two countries are taking such different approaches.
Yeah.
Who's got it right?
That's the million-dollar question, isn't it?
Yeah.
And there's no easy answer.
Okay.
Both approaches have their pros and cons.
Yeah.
And ultimately, it comes down to what works best in each country's specific context.
Sure.
But one thing's for sure, as we invest more and more in renewable energy, figuring out how to incorporate those costs into the cost of capital is going to be a major challenge.
Okay, ready to tackle the next hot topic? This one sounds particularly intriguing, even if I don't fully understand it yet.
Right.
The market risk premium.
Ah, yes, the market risk premium, or MRP.
Okay.
It's a crucial concept, but it can be a bit tricky to wrap your head around.
Well, we love a good challenge here on the deep dive, so break it down for us.
Okay.
What is a market risk premium, and why should we care?
So essentially, the MRP is the extra return that investors expect to get
Okay.
for investing in the stock market compared to a risk-free investment like government bonds.
So it's like the danger pay
Exactly.
that you get for taking on the risk that comes with investing in stocks.
The danger pay for investing in stocks, yeah. And this premium is built into those cost of capital calculations.
Right.
So the higher the perceived risk of investing in a particular company or industry, the higher the market risk premium, and therefore the higher the cost of capital.
Okay, I'm following so far.
All right.
But how do you calculate this mysterious market risk premium?
Yeah.
It's not like there's a giant billboard that says, today's MRP is 5%.
If only it were that easy.
Right.
There are actually several different models and methods that analysts use,
Okay.
and they don't always agree.
So it's a bit of a guessing game?
Not entirely a guessing game, but there's definitely a lot of judgment involved.
Okay.
And this is where things get tricky for regulators,
Okay.
because they need to choose a method that they think is reliable and produces a reasonable result.
Sounds like a recipe for disagreement and debate.
You got it.
Okay.
The AER, for example, has explored various approaches, from analyzing historical stock returns
Okay.
to conducting surveys of investors to see what kind of returns they expect. They even considered using a blended approach, combining results from different methods.
Wow, they're going all out.
Yeah, but even with all that effort, there wasn't enough support for the blended approach.
Okay.
So they ended up sticking with a fixed market risk premium for the duration of their current rate of return instrument.
So playing it safe for now.
Yeah, playing it safe for now.
What about New Zealand? Did they come up with a magic formula?
Well, they use a combination of three main approaches to estimate the MRP.
Okay.
So they look at historical stock returns, they conduct investor surveys,
Okay.
and they analyze empirical data from stock prices and dividends.
So a bit of a three-pronged attack.
Yeah, a three-pronged attack
On the MRP mystery.
on the MRP mystery, trying to get a well-rounded view
Okay.
of what the market risk premium should be.
So different regulators.
Yeah,
Different approaches.
different approaches.
Is there a right answer when it comes to the MRP?
That is the million-dollar question,
Hmm.
and even experts disagree on the best way to estimate it. And of course, the number can fluctuate as market conditions change.
Right.
But one thing is for sure, the MRP is a crucial part of cost of capital calculations. And it's a topic that's going to keep generating debate for years to come.
Well, that's reassuring.
Yeah.
Okay, on to hot topic number 8, stranding risk for gas networks.
Okay.
This one sounds a bit ominous.
It does sound a bit ominous.
What are we talking about here?
And it's especially relevant with the global shift away from fossil fuels.
Okay.
So stranding risk refers to the possibility that assets like gas pipelines could become obsolete or lose value as we transition to cleaner energy sources.
Okay, so like a giant dinosaur skeleton slowly being buried under layers of sediment.
Yes.
Except in this case, the dinosaur is a gas pipeline and the sediment is renewable energy.
That's perfect.
Okay.
And regulators are starting to grapple with how to account for this stranding risk in their cost of capital calculations.
So how do you factor in the possibility that a multi-million-dollar asset might suddenly become a giant rusty paperweight?
Right. That is the challenge. And the NCCC, they actually made a pretty controversial decision in 2022.
What did they do?
They decided to allow for shorter asset lives for gas pipelines,
No. Okay.
essentially accelerating depreciation to reduce that risk of stranded assets.
So admitting that these pipelines might not be around as long as we thought,
Right.
and adjusting the financial models accordingly.
Exactly, acknowledging that the world is changing and our financial models need to adapt as well.
But this decision was met with some pushback.
Oh, yeah.
Right.
It was controversial. The Major Gas Users Group actually took the NZCC to court over it.
Wow.
Yeah.
So this is serious business.
They were not happy.
Did the court overturn their decision?
They did not. The court actually upheld the NZCC's approach.
Wow.
They agreed that stranding risk needed to be addressed and that shortening asset lives was a reasonable way to do it.
So the court basically acknowledged that the world is changing, and our regulatory frameworks need to adapt.
The court said, yes, the world is changing, and we need to account for that.
And it's not just New Zealand.
No, it's not.
The AER in Australia has also started to adopt a similar approach.
The AER in Australia has also jumped on board with this.
Okay.
They recently decided to allow accelerated depreciation for gas pipelines owned by Evo Energy
Oh, hi.
in the Australian Capital Territory.
So the writing is on the wall for gas pipelines.
I think it is.
As renewable energy takes center stage,
Yeah,
these assets are going to face increasing scrutiny
for sure.
and potential write-downs.
Absolutely. And this raises some really important questions about, how we manage this transition and who bears the cost
Right.
of stranded assets.
Big questions.
Yeah, big questions.
Okay, on to hot topic number 9, competition for the right to supply.
All right.
This sounds like a free market dream come true.
This is all about using competition rather than just regulation
Oh.
to drive down costs and encourage innovation. And it's especially relevant for those large-scale renewable energy projects we've been talking about.
So instead of just handing a monopoly to a single company,
Yeah.
we're letting them duke it out in the marketplace?
Let's have a competition.
Okay.
May the best company win.
So we're seeing this play out in a couple of interesting examples.
Yeah.
In the UK, they've been auctioning off the rights to build, own, and operate offshore wind transmission lines.
Yeah, I've been doing that for a while.
And this creates competition among potential developers.
Right.
Which can lead to lower costs and more efficient outcomes.
Exactly.
So win-win for consumers
Yeah.
and the environment.
Potentially win-win.
Oh, capital.
Abijameu, the UK energy regulator, they've been analyzing the results of these auctions to, understand the actual cost of capital
Okay.
for these types of projects.
So they're using real-world market data to inform
Exactly.
their regulatory decisions?
Real-world data.
That's a smart move.
Yeah, I think so.
It is, and it's not just the UK here in Australia. New South Wales has been developing what they call renewable energy zones, or REZs.
Yes, REZs.
I've heard about those.
Yeah.
They're basically designated areas with tons of potential for renewable energy development, right?
Exactly. Designated areas primed for renewable energy.
And to connect these REZs to the grid,
Yeah.
they're building new transmission lines, but instead of just assigning these projects to existing companies, they're running competitive tender processes.
Right. So they're opening it up to competition.
So letting the best company win.
Yeah.
Regardless of whether they're a big established player or a scrappy newcomer.
Exactly.
This not only promotes competition,
Right.
but it also encourages companies to come up with innovative and cost-effective solutions.
Absolutely. Drives innovation.
Sounds like a great way to inject some dynamism into the energy sector.
I think so. I think it's a really positive development.
Okay, on to the final hot topic in our top 10,
Okay.
merits review.
Merits review.
This one sounds a bit legalistic.
Yeah, it does have a legal flavor to it.
What's it all about?
But it's an important concept with big implications for the cost of capital.
Okay.
So basically, merits review is a process that allows regulated companies to challenge a regulator's decision
Okay.
if they think it's unfair or unreasonable.
So it's like an appeals process for energy companies.
Exactly, an appeals process.
And while this might sound fair in principle,
Yeah,
it can lead to some unintended consequences.
it can.
Perhaps.
So imagine a scenario where a regulator makes a decision that would lower energy prices for consumers,
Okay.
but the energy company, they think this decision is unfair, and they decide to appeal it through merits review.
So they're fighting to keep prices higher.
Well, yeah, in a way.
Okay.
And this process can drag on for months or even years, creating uncertainty and delaying the implementation of the regulator's decision.
Wow.
And in the meantime, consumers are stuck paying those higher prices.
So a lose-lose situation for everyone,
Yeah, it can be.
except the lawyers.
Except the lawyers, they're probably doing okay.
And this isn't just hypothetical. This happened a lot in Australia.
Yeah, it did.
Right.
Between 2008 and 2016, over 60% of regulatory decisions were challenged through merits review.
Wow.
And not a single one
Wow.
resulted in a decrease in revenues for the regulated company.
So it was basically a one-way street,
Yeah, pretty much.
always benefiting the energy companies
Yeah.
at the expense of consumers.
At the expense of consumers.
Yeah.
And the Australian energy regulator was not happy about it.
Yeah, but
They argued that merits review is being used as a tactic to extract higher prices from consumers,
yeah.
and that it was creating this very adversarial regulatory environment.
Sounds toxic.
Yeah, it was. And it got so bad that the Australian government actually abolished merits review entirely in 2017.
Wow. That's a pretty drastic step.
It was a big move.
What happened after they got rid of merits review?
Things actually improved significantly.
Okay.
The regulatory landscape shifted dramatically. Instead of constantly fighting in court, energy companies were forced to engage more constructively with regulators and consumers.
So addition by subtraction.
Exactly. Addition by subtraction, sometimes less is more.
Okay.
And, for example, in the 2022 Powerlink Queensland electricity transmission decision, the company approached the determination process with the goal of putting forward a proposal that would be acceptable to everyone involved: consumers, the regulator, and themselves.
That's a refreshing change.
Yeah, it was a refreshing change. And this collaborative approach
Yeah.
led to a much more efficient and less adversarial
Yeah?
regulatory process. And in recent years, the AER has been able to accept most regulatory proposals without having to intervene.
Wow. So by removing the option of merits review,
Yeah.
it actually incentivized
We did.
better behavior.
And more collaboration.
Yep. Sometimes changing the rules of the game can lead to better outcomes for everyone.
That's a pretty counterintuitive outcome.
It is a bit counterintuitive, but it shows that sometimes, you need to think outside the box to get the results you want.
So a valuable lesson for regulators around the world.
I think so. Okay, we've covered a lot of ground here,
We have.
but I know there are a few more points in this document.
Yeah, we've just scratched the surface.
Are there any other interesting tidbits we should touch on?
There are a bunch of other issues that didn't quite make it into the top 10, but are still worth mentioning just to give our listeners a taste
Okay.
of the full cost of capital buffet.
All right, let's do a quick lightning round of honorable mentions.
Okay, lightning round.
Okay, first up, accurately estimating the cost of debt.
All right, so this one's pretty straightforward.
Okay.
Expert speaker.
The AER in particular does a pretty good job at this.
Okay.
Because they have access to detailed information about the debt instruments
Okay.
issued by the companies they regulate.
So no more fuzzy math when it comes to debt.
Right. They can track those actual borrowing costs very closely.
Sounds like they've got their debt calculations down to a science.
Pretty much.
Okay.
But then there's a more theoretical debate around the
Okay.
convenience yield
Yeah.
and the risk-free rate.
You ready to go down this rabbit hole?
Always up for an adventure.
Okay.
Lead the way.
So traditionally, government bonds
Yeah.
have been considered like the gold standard
Right.
for risk-free investments.
Yeah.
They're backed by the government,
Right.
so they're seen as extremely safe.
You'd think a government would be good for its money.
You would think so.
Yeah.
But here's the catch.
Okay.
Some people argue that even governments
Yeah.
can default on their debts.
Yeah. Oh, yeah. We've seen some crazy things happen
It's true.
in the world lately.
It's true. We have.
So,
And that's where this idea of convenience yield comes in.
okay.
It's basically an adjustment to the risk-free rate
Okay.
to account for the fact that even government bonds carry a tiny bit of risk.
Okay.
Some even suggest using high-quality corporate bonds instead of government bonds as
Okay.
the benchmark.
So it's like adding a little danger pay,
Exactly.
even for those supposedly
A little bit of danger pay.
super safe investments.
Even for those super safe investments.
Okay.
But so far, most regulators haven't been convinced
Okay.
to make this adjustment.
So government bonds still reign supreme?
Yeah, for now at least.
Okay.
It's definitely something to watch.
Interesting.
Now, another interesting point is the weighting of debt in equity
Yeah.
when calculating the overall cost of capital.
Right.
This is where companies decide how much of their funding comes from borrowing debt
Right.
and how much comes from investors.
Or equity.
These
So it's like choosing between taking out a loan
Yeah,
or selling shares in your company.
exactly. And to figure out the overall cost of capital,
Yeah.
you need to combine the cost of debt and the cost of equity.
Right.
And this usually involves choosing a ratio,
Yeah.
like 60% debt and 40% equity.
So it's like a recipe, but instead of flour and sugar, we're talking about debt and equity.
Exactly, I like that.
Okay.
And you might think that the specific ratio
Yeah.
would have a huge impact.
Right. You'd assume that more debt would mean a higher cost of capital because you're paying interest
Yeah.
on those loans.
That's true to a certain extent, but it turns out that as long as you're not using like extreme levels of debt,
Yeah.
the actual weighting
Right.
doesn't dramatically change the final result.
So it's more about finding a balance
Exactly.
than obsessing over the precise percentages.
It's more about balance.
Okay.
Now, another topic worth mentioning is financeability testing.
Okay.
And this basically assesses whether a company can actually get the financing they need
Right.
to carry out their big, ambitious investment plans.
So it's like checking if they can actually get the loan approved before they start digging up the ground for that new wind farm.
To make sure they can actually get the money before they start spending it.
And the NZCCC, at least, has said that this is primarily
responsibility of the companies,
right,
not the regulators.
So a put your money where your mouth is approach.
I like it.
Okay.
Make sure you can actually back up your promises.
Yeah. All right. What else is on our list of honorable mentions?
Well, there's a concept called TOTEX.
TOTEX.
Which stands for total expenditure.
Okay.
And this is a regulatory approach used by Ofgem in the UK.
Right.
And it involves setting a cap on how much a company can spend on both operating expenses and capital investments.
So it's like giving them a budget and saying, don't go over this or else.
Pretty much it's a way to try to control costs and encourage efficiency.
Yeah.
And the NZCC considered adopting this approach, but ultimately decided against it.
So another example of different regulator.
Right.
Different philosophies.
Different strokes for different folks.
Oh, okay.
Now, there's also something called split cost of capital.
Split cost of capital.
Which sounds a bit complicated.
Okay.
But it's actually pretty straightforward.
Okay. I'm all ears. Explain it to me like I'm 5.
All right. So imagine you're a company with some old power plants and some brand new wind farms. The split cost of capital approach says you should use different cost of capital calculations for those different assets.
Because the risks and returns are different.
Exactly.
So for old established assets versus new cutting edge ones.
You got it. And the NZCC considered this approach. But decided that their existing framework was already doing a good job of incentivizing new investments.
So keeping it simple.
Yeah, sometimes simpler is better.
Okay, what else is on the list?
Well, the NZCC has another unique approach that's worth mentioning. They actually incorporate the standard error of the cost of capital into their calculations.
Standard error. That sounds like something from a statistics textbook.
It is a statistical concept, but it's actually pretty important in this context. Basically, it's a way to acknowledge that there's always a margin of error. In any calculation.
Right.
Especially when you're dealing with something as complex as the cost of capital.
So it's like saying, we're pretty sure this is the right number.
Exactly.
But there's a chance we could be off by a bit.
There's always a chance we could be off by a little bit.
Okay.
And the NZCC takes this margin of error very seriously.
Right.
They adjust the final cost of capital value. Based on their judgment about where that probability of error should lie. They consider things like, the potential consequences of setting the cost of capital too high or too low.
So they're really trying to account for all the uncertainties.
Account for all the uncertainties and be as fair as possible.
Yeah.
It's a very nuanced approach.
All right, what else have we got?
Well, there's the issue of indexation of the regulatory asset base. It's a bit of a mouthful.
Yeah.
But it's essentially a way to protect investors from inflation.
Because if the value of money is going down, you need to adjust the value of assets accordingly.
Exactly. And the NZCC used to not index the regulatory asset base for TransPower, a major electricity transmission company. But they've recently changed their tune and decided to start doing it.
So they're recognizing that inflation is a real threat.
Yeah.
And taking steps to mitigate it.
Inflation is a real threat these days, and investors need some protection from that.
What else?
And last but not least, there's the ever-important issue of inflation forecasting.
Oh, yeah. Trying to predict the future.
Yeah.
The prices. That's got to be tricky.
It is accurately forecasting future inflation.
Yeah.
Is crucial for all sorts of financial models. Including cost of capital calculations.
Right. If I could predict the future, I'd be on a beach somewhere not talking about cost of capital.
Well, the AER actually did a deep dive into inflation forecasting back in 2021. And they highlighted just how complex and important it is.
So a fitting end to our lightning round.
Yeah.
Of cost of capital honorable mentions.
We made it.
We made it.
We've covered a lot of ground today, haven't we?
We have, It's amazing how much depth there is
Yeah.
to this topic.
We've peeled back layer after layer
It's like we've peeled back layer after layer
of the cost of capital onion.
of the cost of capital
And I bet you're starting to see why this is such
Yeah.
a hotly debated
Yeah.
and constantly evolving area.
Absolutely.
Yeah.
But I have to ask, with all these complex calculations and different approaches, does anyone truly know what the right cost of capital is?
That's the million-dollar question, isn't it? And the answer is it depends.
Okay.
It depends on the company, the industry, the regulatory environment,
Yeah.
a whole host of other factors.
Right.
There's no single magic number
Yeah.
that applies to every situation.
So it's more about finding a balance,
Yeah.
making informed judgment,
Informed judgments.
and being willing to adapt as the world changes around us.
Exactly. And that's what makes this such a fascinating and challenging field.
Okay.
Requires a blend of technical expertise, economic understanding, and a keen awareness of the bigger picture.
All right. Well, I think we've officially earned our cost of capital PhDs today.
I think we have.
Maybe not quite, but we've definitely gotten a crash course
Yeah.
in one of the most important topics shaping
For sure.
the energy industry today.
One of the most important.
And now it's time to put all this knowledge to good use. What are some key takeaways our listeners should keep in mind
Okay.
as they navigate this complex world?
Well, one thing to remember is that cost of capital calculations are not just abstract numbers on a spreadsheet.
Right.
They have real-world consequences
Yeah.
for energy prices, investment decisions, and the transition to a cleaner energy future.
Right, because ultimately those costs are going to be passed on to consumers.
Exactly. One way or another, it all comes back to the consumer.
So it's important to pay attention to how regulators are incorporating those climate change objectives into these calculations.
Absolutely. Are they incentivizing investments in renewables? Are they accounting for the risks of stranded assets?
Yeah.
These are questions we should all be asking.
Absolutely. And we also need to watch how regulators are dealing with that shrinking pool of comparable companies we talked about.
Right.
As more utilities are taken private, that lack of data could lead to less accurate cost of capital calculations,
For sure.
which could ultimately hurt consumers.
It's like trying to bake a cake without knowing how much flour to use.
Yeah, you might end up with a disaster.
You could have a real mess on your hands.
And finally, don't forget about that ongoing debate over the market risk premium.
Yeah.
That mysterious number that seems to have everyone scratching their heads.
The MRP is still a big question mark.
Yeah.
And it's a fundamental input into these calculations.
Right.
So pay attention to how regulators are approaching that.
Right.
Are they sticking with traditional methods, or are they exploring new ways to get a more accurate picture of market risk?
So lots to keep an eye on.
Lots to watch.
It's almost like we need to become armchair. Cost of capital experts.
Maybe not experts, but at least informed citizens who can ask the right questions and hold decision makers accountable.
Well said. And that's what the deep dive is all about.
Exactly.
Taking these complex topics and making them accessible and engaging.
That's what we're here for.
So we can all be more informed and empowered.
Exactly. Knowledge is power.
Well, there you have it, folks. A deep dive into the fascinating
We've gone deep.
and often bewildering world of cost of capital.
I hope you enjoyed it.
It's amazing how much goes into calculating this and the impact these numbers have on energy bills and investment decisions.
Yeah, it's one of those things most people don't think about until they see their energy bill go up.
Exactly. But now that we've taken this deep dive, we can't unsee it. It's like we've unlocked this secret level
It changes your perspective.
of understanding about the energy industry.
Yeah, for sure. And, with climate change driving massive investment in renewables and other infrastructure, figuring out this whole cost of capital puzzle, it's only going to get more complex and more important in the years to come.
So what can we as energy consumers and concerned citizens do with all this knowledge? What should we be paying attention to?
Well, I think the biggest thing is to keep a close eye on how regulators are incorporating those climate change objectives into their calculations.
Yeah.
This is going to have a huge impact on what kind of energy infrastructure gets built and how much we pay for it.
Right, because ultimately those costs are going to trickle down to us, the consumers.
One way or another.
Exactly. And another thing to watch is how regulators are dealing with that shrinking pool of comparable companies we talked about. As more utility companies go private, it's going to get harder to get accurate cost of capital calculations.
Yeah, that lack of data could really skew things.
Right. It's like trying to bake a cake without knowing how much flour to use.
Exactly. You might end up with a disaster.
You could have a real mess on your hands.
Yeah.
And finally, don't forget about that ongoing debate over the market risk premium.
The MRP.
The MRP, that mysterious number that seems to have everyone scratching their heads.
Yeah, it's a fundamental part of these calculations, and there's still no consensus on the best way to estimate it.
So pay attention to how regulators are approaching that. Are they sticking with traditional methods, or are they exploring new ways?
Yeah, are they innovating?
To get a more accurate picture of market risk.
Right. Are they thinking outside the box?
So lots to keep an eye on.
Lots to watch. Lots to think about.
It's almost like we need to become armchair cost of capital experts.
Well, maybe not experts, but informed citizens.
Right.
Who can ask the right questions and hold decision makers accountable.
Well said, and that's what the deep dive is all about.
That's our mission.
Taking complex topics and making them accessible and engaging.
We want to make this stuff understandable.
So we can all be more informed and empowered.
Exactly.
Well, there you have it, folks. A deep dive into the fascinating
We went deep.
and often bewildering world of cost of capital.
I hope you enjoyed the journey.
We hope you enjoyed it, and we encourage you to keep exploring these ideas, do your own research, and most importantly, stay curious.
There's always more to learn.
Absolutely. We're all on this learning journey together. Thanks for joining us on The Deep Dive.
Until next time.